Are you ready to build, grow, and protect your investments? Welcome to the Index Investing Show, where we give you the tips, tools, and philosophy for reaching your financial goals. And now, your host, inventor of the Portfolio Report Card and author, Ron DeLegge.
All right, coming up on today's program, a contest between two investors. Who wins? Also coming up, we're going to give you a recap of what's going on in global financial markets. If you'd like to join us to talk about a particular stock, mutual fund, ETF, or investment strategy, the number is 844-305-7800. You can also tweet the program live at Index Show is where you find us on Twitter. Taking a look at global financial markets, beginning with the total U.S. stock market. Off to a very strong start. SCHB is the ETF tracking the total U.S. market, ahead by almost 7% since the beginning of the year. We've got the international markets doing pretty well also. Developed market stocks from places like Japan, the United Kingdom, and Australia ahead by 6.5%. Emerging markets are the strongest area in terms of stock market performance globally. VWO tracks that area ahead by 7.6%. And in terms of other equity markets, we've got global REITs performing very strongly. Real estate as a group ahead by 8.2%. REET follows that area. And then two final areas, commodities, USCI ahead by just a nudge over 3%. And then the total U.S. bond market up 30 basis points. BND tracks that area up 0.30%. So that's your big picture view of what's going on in global financial markets. The Greed Fear Index that CNN publishes is now in the greedy territory. Wow, what a difference a month makes. Last month, I remind you, we were at 4. Today we're at 58. Remember, 100 is extreme greed. 0 is extreme fear. Again, we were at 4 1 month ago. Now we're at 58. And we have swung into greedy territory as we've seen stocks outperform bonds by around 7.2% during the last trading days. This, by the way, is the strongest performance for stocks relative to bonds in the past 2 years. And it indicates that investors have found a recomfort here with stocks. We're going to tell you what's going on sector-wise. Coming up a little bit later, Dan Dolan will be joining us to talk about the industry sector trends within the S&P 500. Of course, one of the go-to tools that I use to track industry sector performance and the ETFs following them is the Select Sector Spider app, which is available at the App Store, Apple's App Store. And, of course, there are 11 industry sector ETFs tracking each of these areas of the S&P 500. So we're going to tell you what's going on and get you on top of all of that. So stay tuned for that coming up a little bit later with Dan Dolan. 844-305-7800 is the number. We're here. And if you'd like to join us to talk about anything on your mind related to the rebound that we're seeing in stocks and the strong performance just across the globe, not just here in the U.S. Now, taking a look at some of the things on our Twitter feed, of course, Twitter at Index Show, you can follow us 24/7. So a couple of things I had to say this past week. Having a high IQ or being a good saver does not automatically make you a good investor. That's very important to remember. How about this one? The best built investment portfolio, accompanied by poor habits, will achieve superior results with great difficulty. Isn't that true? The things that we do to ourselves, we self-destruct. Many times, isn't it true that we're our own worst enemy? And really, it's about looking at ourselves in the mirror and taking responsibility for what we've done as investors. The performance results that we get are really our responsibility. If we have good results, we are to blame for that outcome. If we have bad results, we are to blame for that outcome. The human thing to do, of course it's a flaw, but the human thing to do is to blame others, to point fingers, especially when things don't go right. But what we're trying to help you understand here is that the best built investment portfolios accompanied by poor habits will achieve superior results with great difficulty. We want you to achieve superior results with great ease. And the way this happens is by cultivating the right mindset, the right habits. And several years ago, I did some research on this because I really wanted to know what were the habits, what were the things that contributed to positive outcomes. And so I'm going to share with you a little bit later some of the key points of that in order to help you to cultivate the right mindset. Also coming up, we're going to talk about a contest between two investors. So let me just lay the foundation of the conversation. This contest is between a 25-year-old and a 50-year-old. So each of them sets aside a portion of their income to save and invest. And we're going to explain to you who has more money by the time they reach 65. Who wins the contest? And this really is a very, very important lesson. I'm not going to tell you what it is just yet because I want to keep your appetite piqued. But the point is that it's going to explain to you a very important concept and lesson that we all can learn from as investors. So stay tuned for that. It's a contest between two investors. And we've done this before in the past. I think we always like to see a contest, a battle. We did this, what I call portfolio wars, where we matched up two separate portfolios from two separate investors. We pinned them head to head. And it was what I call a portfolio war. And who had the better portfolio? So this is going to be almost a similar exercise with a little bit of a tweak because these are not real-life investors. The Portfolio Wars was an actual contest of two actual investors that had submitted a portfolio report card, and I had analyzed and graded each one of their portfolios. And then what we did was we took those grades and we put them head to head, who had the better grade, who had the better built portfolio, and that became Portfolio Wars. Well, this is a similar exercise, but with a different context. The two investors that we're talking about are theoretical. They're not real-life investors like Portfolio Wars, but they do have the same goal, and that's, of course, to make the most money. So who wins the contest? Is it the 25-year-old or the 50-year-old? And we'll explain in the next segment what the contest is. So stay tuned for that. If you're just joining us, you're listening to the Index Investing Show. I'm your host, Ron DeLegge. We're here every week at this same hour. If for whatever reason you can't listen to our regular radio broadcast, you can pick up our podcast. It's available at our website, indexshow.com, as well as other fine platforms like Spotify, Google Play, and YouTube. So it's time for us to take a quick break. If you'd like to join us, 844-305-7800 is the number. And at Index Show is my Twitter handle. Be sure to tweet us or call us. We'll be right back after this short break. Go nowhere.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
Okay, the February issue of ETF Guide Premium is out, and I encourage you to pick up a copy. We talk about generating income. We do this every single month, February ETF income trade. That's one of the most popular features of ETF Guide Premium, and it's very simple. It's a hypothetical all ETF portfolio that sells monthly covered calls with the purpose of generating monthly income. And we've done this since February of 2012, going all the way back to then, and kept track of this every single month. On average, the portfolio income ETF portfolio has generated $612 of monthly income. It's a hypothetical $100,000 portfolio, and altogether, almost $50,000 of monthly income has been generated since February of 2012. So this is another excellent strategy for those of you that are at the point of generating income from your portfolio. That's the focus as opposed to growth, and you want to add that to your dividends. This is something that you should definitely look at. So go to etfguide.com, become a premium member, and you can follow those monthly trades. Some of the other things that you should be aware of, it's been a strong rebound that we've seen here so far for stocks in 2019. And what a difference a month makes. Of course, the stock market had a very bad fourth quarter, one of the worst on record. And yet we see a sharp rebound. Will it last? Well, one of the things that we always watch, of course, is fundamentals and earnings. And right now, S&P 500 companies are already reporting fourth quarter earnings. So to date, we've got 22% of the S&P 500 have actually reported results. So the question is, how have those results been? Well, the percentage of companies reporting actual earnings per share above estimates is right now 71%, which is pretty darn good. But at the same time, it's equal to about the 5-year average. So in aggregate, if we look at all of this together, besides that, companies are reporting revenues that are 0.2% above estimates, which is slightly below that 5-year average. So although they're exceeding estimates, it's really not by much, and it's also at the lowest rate in 5 years. Now, if we look at this from a sector perspective, and a little bit later, we're going to talk about industry sector performance and some of the key trends that you need to be aware of with Dan Dolan. 10 of the 11 sectors within the S&P 500 are still reporting year-over-year earnings growth. And 6 of those sectors are reporting double-digit earnings growth. Which ones are those? Energy, industrials, and communication services sectors. So those 3 are leading in terms of delivering double-digit earnings growth. Energy, of course, has been beaten down for quite some time. And look at here. What a strong rebound. This is one of the top-performing industry sectors in the S&P 500. XLE tracks that area. And that particular ETF, since the start of the year, has jumped 9.7%. So that's one of the top S&P 500 sectors. So we can see that earnings, for the most part, have been pretty good, even with this ongoing trade dispute with China that the U.S. has, and that many are watching. It still has not affected earnings in a totally negative way. But at the same time, we see it impacting incrementally earnings in terms of a minor deceleration. But if it doesn't get resolved soon, we're going to see this deceleration continue. So this is definitely something to continue to watch, and it's something we'll keep you posted on. 844-305-7800 is the number. We're here if you'd like to join us to talk about whatever's on your mind, a particular stock, mutual fund, ETF, what have you. We can do that. So let's talk about this contest. This contest, we don't call it Portfolio Wars, but this particular one is what we'll call the money battle. And portfolio wars, of course, is a completely different thing. It's one investor's portfolio versus another. This is more of a money battle, a contest of who has more money by the time they reach age 65. So investor A is 25 years old. Investor B is 50 years old. So here's how it starts. Investor A, that's the 25-year-old, starts out with $0, but they're managing to save $3,600 a year. That's $300 a month. They do that for 15 years, and then they stop. And then they let their money sit and grow until reaching age 65. Now, we're going to assume that they're able to get a 7% rate of return on that money that sits. So that's investor A. Investor B is 50 years old. This investor starts with $0 just like the 25-year-old, but they're saving more money. Investor B is saving $7,200 per year. So that's basically a double compared to investor A. And so they do the same thing. They save that money for 15 years. 15 years, and then what happens? Well, they get the same rate of return, 7%. And what happens by the time they reach age 65? Who wins the battle? Well, I'm going to tell you a little bit later who wins the battle, but I just wanted to first set up the money battle and explain to you what's at stake. Because we have two very different investors age-wise. One is 25, one is 50. They're both doing a very similar exercise. They're saving on a consistent basis every month. But investor A is only saving $3,600 a year. Investor B is only saving double that, $7,200. So who wins the contest at the end of 15 years? They're both getting the same rate of return, 7%. Who has more money? So that's the question. So we're going to explain to you who wins this money battle coming up a little bit later. Before we get to the next segment, we're going to, of course, talk with Dan Dolan with the Select Sector SPDR ETFs. He's coming up. He's warming up in the bullpen. Want to just quickly tell you about what some of the top ETFs are in terms of, these are leveraged ETFs. They aim to magnify performance. We told you earlier about emerging markets being one of the top areas globally in stock market performance. Well, take a look at ticker symbol EDC. That's Edward David Charlie, EDC, which aims for triple daily performance to emerging market stocks, now ahead by almost 25% since the beginning of the year. I mean, we haven't even got out of January, and EDC is just going wild, going nuts. And so that's the bull version. TECL aims for triple daily performance to technology stocks. That's been a great trade. TECL ahead by almost 18%. Another top performer has been SPXL, which aims for triple daily performance to the S&P 500. That's been a great tactical trade here in January. SPXL is the ticker again. That one ahead by almost 19%. We'll get you caught up on what some of the other key industry sectors are doing, as well as a couple of other leveraged ETFs that I want to share with you on the program. This is the Index Investing Show. I'm Ron DeLegge. At Index Show is my Twitter handle. Stay with us. We're going to talking sectors in the next segment.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
Will interest rates continue to rise? For bold trades on U.S. Treasuries, now may be time to take a closer look. Trade TMF or TMV, Direxion's daily 20-plus year Bull and Bear 3X ETFs. Direxion leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direxion shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.direxioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor Foresight Fund Services, LLC.
Legendary investor Bernard Baruch once said, "The main purpose of the stock market is to make fools of as many people as possible." Did you know that crashing financial markets are when most of the fools are made? What about you? Will the next bear market turn you into a fool? How can you protect your investments from losing value? Take Ron DeLegge's online class titled Profit During Crashing Markets, a step-by-step guide. Go to indexshow.com and click on the enroll button. Get started today at indexshow.com.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
We're pleased to have with us Dan Dolan, Director of Wealth Management Strategies at the Select Sector SPDR ETFs. There's 11 and a lot to talk about on the program. Dan, welcome back to the show.
Thank you, Ron.
Let's begin with John Bogle, of course, a legend and a vocal advocate for index investing. He passed away recently. What is it about John Bogle that you liked most, and what lessons do you think that he taught that can help investors with the way that they approach their investing?
I think the pure determination of the man was incredible. You know, for 40 plus years, he's talking about a better way to invest and trying to help investors keep more of what their portfolio earns. So, you know, his message never really wavered much. It was always the same, and he was determined to get it across. In the end, he really won, and it was a winner for thousands and millions of people that invest in index funds today. And I think the one piece of it, it may not just be index funds, but it is the keep more of what your portfolio earns message. So keep expenses low. And you have a choice when making investments, and take a look at the prospectus, understand how much you're paying to the advisor, and try to push those expenses as low as you can, because the compounding effect of keeping your money really is important over time. And it's a very powerful message that he talked about for a long time.
Talk about the Dogs of the Dow strategy, which calls for picking the worst performing stocks within the Dow Industrial Average, and the ones, of course, with the highest dividend yield. So atop 2019's list are some of the formerly beaten up companies like ExxonMobil and Chevron, both part of the once beleaguered energy sector, which is now a top performer in the S&P 500. Seems like value investors saw lots of value in energy stocks. What are your thoughts?
Well, it's a classic commodity, right? So the entire sector moves with the price of oil, and oil has rebounded a bit. So when you look at these quality companies and the whole concept of the Dogs of the Dow, buying these beaten down names, proves out over time to be a pretty good strategy, particularly because of the dividend, right? So if you're going to play the energy sector, which I highly recommend in everyone's portfolio, if anything, just as a hedge, because so much of what you spend out of your own personal budget goes to gas or heating your home or things like that. So I think staying in the energy sector makes sense. I think the rebound that we saw here, we're up 8-9% year-to-date in January, makes sense. And on top of it, the names that you mentioned are the biggest and best in the industry. So why not take advantage of high yields on Exxon and Chevron, add it to your portfolio, and over time, I think long-term strategy, it makes a lot of sense.
Dan Dolan with the Select Sector SPDR ETFs joining us. Be sure to download the Select Sector SPDR app. It's free and available at Apple's App Store. Now let's talk about corporate bankruptcies, which are once again in the news headlines. Investors are scrambling for cover. We've seen this in the downtrodden retailers, companies like Brookstone, Nine West, Claire's, the Bon-Ton stores, all filed for bankruptcy over the past year. Yet, you take a look at the consumer discretionary sector SPDR, that's ticker symbol XLY, which has outperformed the broader U.S. stock market. So why has XLY done so well despite its exposure to some of these brick and mortar retailers?
That one's easy. The largest component there is Amazon. It's about 23% of XLY and has continued to perform extremely well. But there's a little bit more of an explanation to that not only is Amazon, but the diversification of owning a basket of securities helps you deal with some of the bankruptcies that you're talking about. So in addition to Amazon, you have Home Depot and Lowe's and TJ Maxx stores and Target and Dollar General. So those names are also in that basket, the consumer discretionary sector SPDR. So as some of these retailers are having a hard time, others are gaining market share. So owning the basket, minimize your single stock exposure, and benefit from the sector growing. And a name like Amazon is carrying in the sector.
When stocks are falling hard, like they did in the final part of 2018, people don't have to make a sell all or nothing decision with their investments. One strategy is to keep the entire portfolio fully intact and to simply add insurance protection with put options on ETFs that you're holding inside the portfolio. What are the advantages of hedging a buy and hold portfolio versus selling the entire thing out of fear?
Well, you go back to John Bogle. I mean, stay invested is, one of his primary messages, that you don't know when things are going to bounce back. And when you look at December, the world was coming to an end, and all of a sudden in January here, we're up over 5-6% or so. So staying invested is key. So how do you deal with that? And let me just pick up on one piece of what you mentioned, the exposure. Some people have a lot of exposure to one name, whether you worked at Exxon your whole career, whether you own a bunch of Apple stock, and you have huge gains in those things. How do you deal with kind of keeping those gains but not selling those positions and realizing the capital gains associated with that? And one strategy is simply to take a look at, a stock like Apple is a major component in XLK, the technology SPDR, that, to your point, you can hedge by shorting or buying puts, whatever your strategy is, that sector, maintain your exposure to your it could be a company stock that you work for, and do not realize a capital gain in the process. So between buying puts, some strategies of shorting, some more sophisticated type things, there's a number of ways to go with ETFs that can help in the process. That's fairly inexpensive when looking at other options.
Dan Dolan with the Select Sector SPDR ETFs joining us. Download the Select Sector SPDR app. It's free and available at Apple's App Store. As a group, the 11 Select Sector SPDR ETFs lead all sector funds by assets. They also lead by trading volume. So let me ask you, Dan, why should investors take note of trading volume before deciding on a sector ETF?
Trading volume is simply an indication of interest in what most investors care about. So when there's tremendous demand, there's tremendous interest in an ETF, you'll see trading volume. On average, we traded at Sector SPDRs, the 11 Sector SPDRs together, traded 170 million shares per day in 2018. And what that does for all investors, whether you're an individual investor buying 100 shares at a time or an institutional investor that's buying a million shares at a time, the volume keeps the spreads very tight. So the difference between where you buy it and where you sell it is a cost to an investor. And when you trade a lot, those spreads tend to be very narrow. So the Sector SPDRs trade 1 penny wide pretty much all the time, which makes it inexpensive to get in or get out. So volume, interest in the product, when you trade that much, your spreads are tight. It reduces the cost to investors to get in or get out of a security.
Yeah, and that's an important point. A lot of times there's so much focus on just expense ratios that investors sometimes lose sight of the importance of watching those bid-ask spreads and keeping them as tight or as low as possible. Now, one question before you take off. Some of the rate-sensitive industry sectors like financials, ticker symbol XLF, along with REITs, ticker symbol XLRE, have really jumped to life. So what's behind this move?
Well, I think there's a couple things going on with the financials, maybe a little bit different than pure rates. I think financials, it's all about earnings. If you look at the first quarter reporting that's taking place year to date, many financials are exceeding expectations with their numbers, and we're seeing some outperformance of the stocks because of that. On the REITs or utility side, kind of traditional income-oriented sectors, the belief is that the Fed may be almost done. So if the Fed is done, it should be good for those rate-sensitive stocks. You stop seeing rate increases, these sectors could rally.
Excellent. Well, we appreciate you giving us your insight as always and the latest sector trends. You just heard there from Dan Dolan, the Director of Wealth Management Strategies at the Select Sector SPDR ETFs. Go to sectorspidr.com for more information. I'm Ron DeLegge. This is the Index Investing Show. More ahead when we come back. Go nowhere.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
Okay, we want to tell you before we complete the money battle between investor A and investor B, want to tell you a little bit about what's happening in terms of specific countries. And there are or regions. We told you earlier that emerging markets were one of the hottest areas in terms of performance here in early 2019. And a couple of specific regions that are standout performers so far. Brazil, BRZU, this ETF aims for triple daily performance to Brazilian equities, ahead by 47% since the start of the year. Now, I should have mentioned this, I'm going to mention it right now, but emerging markets, for the most part, has been a underperformer over the past year. But when we were sinking last quarter, when stocks were sinking, this was one of the areas that interestingly held up, Brazilian stocks. And I don't know what the explanation of that is, because Brazil is an economy that's very much closely tied to commodities and oil and energy prices. They're a huge producer of coffee as well. But BRZU has been a great performer so far in 2019. And even when stocks were selling off, like they did last quarter, Brazil still had pretty decent relative performance compared to some of these other individual countries as well as regions. Speaking of regions, LBJ tracks Latin American stocks. That is another outperformer. LBJ is up almost 40% since the start of the year. So put those two ETFs on your watch list. Both of them are from Direction. Coming up on next week's program, Sylvia Jablonski will be with us. We'll be talking with her about some of the latest happenings at Direction Investments. They just launched some new thematic weighted exchange traded funds. They made some adjustments also to their Portfolio Plus ETF lineup. And so we're going to talk with Sylvia about that and much more. Be sure to join the program next week. Now, let's talk about the mindset, cultivating the right mindset. I told you earlier that investing habits are so important, and it can actually help us or hurt us depending on what kind of habits we have. Now, if you've got good habits, it will likely lead to good results. If you have bad habits, the opposite is true, right? It's going to lead to not good results, but bad results. So it's important to understand, well, what kind of investor am I? It's a self-examination. So, for example, am I distracted? That's a bad habit. Do I spend money more than I make? Am I a spendthrift? Do I respond after change? Or do I respond before? Do I anticipate change, right? It's a bad habit to be reactionary. Am I proactive, right? There are some, of course, that are inactive. They're responseless to change. Do I create opportunity or do I create excuses? See, there's another bad habit, creating excuses. Do I control my emotion or am I an emotional person? The inactive investor is emotionless. Do I confront problems when they arise? Or do I regret problems? Right? That's a bad habit, to regret problems and then to do nothing about it. Or am I frightened by problems? See, these are some habits. These are some things that will help you to do that self-examination so that you can cultivate the right mindset. And this is, by the way, something else that we offer. at ETF Guide is a guide on how to become a proactive investor that cultivates good habits. And so you can go to etfguide.com, become a premium member, and this will be part of your learning program, this sheet of good habits and then a comparison of the bad habits that will hold you back so that you can understand what you need to cultivate and what you need to avoid. So let's get back to the money battle. We started this at the beginning of the program. We pitted a 25-year-old investor versus a 50-year-old investor. We told you that each of them saves a different amount of money. The 25-year-old saves only $3,600 a year. The 50-year-old saves double that. They both earn the same rate of return, 15%. They both invest over the same time frame, 15 years. Well, actually, they save that money for 15 years. But the difference is, at age 65, the 25-year-old, by the time they reach 65, that money has grown to $547,596. Remember, they saved for 15 years and then they stopped. They just let that money sit. They let it compound at a 7% rate of return. And that's how much they wound up with, over $500,000, even though the 50-year-old saved $7,200. They invested that money and let it sit for 15 years at a 7% rate of return. They wound up with, at age 65, $191,286. So the money battle, who won? Well, it was a 25-year-old. So why is that? Why is that the 25-year-old won? Well, we talked about it earlier in that segment with Dan Dolan at the Select Sector Spiders. He alluded to something very important called the compounding effect of money. So what is the compounding effect of money? Well, compound interest is the eighth wonder of the world. He who understands it earns it. He who does not pays it. And so the 50-year-old investor invested a total of $108,000 over 15 years, whereas a 25-year-old saved just $54,000 over 15 years. So how is it that they wound up with the 25-year-old almost 3 times more than the 50-year-old by the time they reach retirement age? At the same return. Well, the game-changing difference is that the 25-year-old got an early start and had the benefit of compounding their money, that interest upon interest upon interest, over 40 years. Whereas the 50-year-old got a late start and was thus able to compound their money for just 15 years. So this combination of interest upon interest upon interest and over time, that's the magic. That's the magic of compounding interest. By the way, I should mention this. What if that same 25-year-old keeps saving $3,600 a year all the way to age 65? They wind up with an extra $244,000. And if they can save just an extra $100 a month, they'll surpass $1 million by age 65. So the moral of the story here, and this is a very important story about the time value of money, the importance of starting early, and it shows you that the money battle can and will be won by those who turn the compounding interest effect to their favor. And so this is a money battle that will hopefully help you understand the value and the importance of starting early. Now, even if you got a late start, you're still going to be better off than the person that didn't start at all. And so the money battle in that case, those of us that got started late, can still be won to some degree. So we hope that makes sense. We hope that this will help you to enlighten your own investment approach. So coming up on next week's program, Sylvia Jablonski at Direction Investments will join us. Be sure to tune in and go to indexshow.com to catch us 24/7.
Thank you for listening to the Index Investing Show with Ron DeLegge. Connect with us on the web at indexshow.com. And be sure to subscribe to our podcast at iTunes, Spotify, or Google Play.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.